Credit scores influence every financial decision we'll ever make, and the vast majority of us know nothing about them. Let's change that.
Here is everything you'll ever need to know about credit scores. Let's start with a definition. In simple terms, it's how lenders judge your trustworthiness with money. How likely are you to pay your bills on time? Why do credit scores exist today? They make lending faster, safer, and more fair. By having everyone measured the same way, we can see who deserves more trust with money. The more trustworthy you are, the better your score. The better your score, the more likely you are to be approved for a loan or credit card. The larger your loans and limits can be, and the lower the interest rate they'll have. But why do some people pay more interest than others? This is risk-based pricing. Simply put, banks need an incentive to loan to risky people. Higher interest rates are this incentive. Let's assume you borrow $1 million for a home mortgage that you plan on paying off over 30 years. Having a higher credit score leads to saving money in your monthly payments and overall. You didn't have to do anything, you just saved that money. You can see how large an effect having good credit can benefit you. The most popular credit score today is the FICO score. About 90% of lenders rely on FICO. FICO uses a complex formula to determine each person's unique score. FICO doesn't directly talk to most lenders. Instead, there are 3 major U.S. credit reporting bureaus that use FICO to report your score. Each bureau uses your FICO score differently and thus comes up with a different number for different purposes. They all do the same thing. Judge trustworthiness. FICO scores range from 300 to 850. The higher, the better. In general, a score above 780 is excellent, above 660 is good, above 500 is okay, and below 500 is considered bad. If you've never borrowed money or used credit, then you won't have a score. All of your credit history is compiled into a credit report, which is used to make all of your scores. The history of each of your credit accounts makes up the majority of a credit report. A credit account is something like a credit card or a loan. Each card or loan is its own account. Each account tells FICO how trustworthy you've been. Your credit score is dynamic. This means it is constantly changing and being updated, usually on a monthly basis. If you missed a payment last month, that will lower your score. However, if you missed a payment years ago and have been perfect since, then it has gone back up. So now we've covered what a score is, why it matters, and how it works. But how exactly is your credit report turned into a score? All credit scores are determined using 5 main variables. Some variables have more weight than others. The 5 are payment history, utilization, age of accounts, recent history, and credit diversity. Overall, 10% of your score is determined by the quantity and diversity of credit types you use. A wider variety of credit types improves your score. Is it a good idea to get a loan just to improve your credit? No, only take out a loan if you actually need it. Use credit cards to help your score if you don't need a loan. The more credit cards you have, the better for your score, even if you never use them. The only time you should ever close a credit card account is if it has an annual fee. Next, the age of your accounts affects your score. Having a long credit history shows that you're consistent. Should you get a credit card at 18? The long answer is in my video on credit cards. The short answer is yes. The age of your oldest account, youngest account, and the average are all considered. About 15% of your score is determined by the length of your credit history. An additional 10% looks specifically at recent history, which is anything that has happened over the last 2 years. The biggest element in recent history is credit inquiries. There are 2 types of inquiries, hard and soft. Every time you apply for a credit card or loan, you initiate a request for credit, which is a hard inquiry. Because it looks risky to suddenly apply for a lot of credit at once, FICO temporarily lowers your score a few points for each credit application you make. Credit cards each count as their own request, but multiple applications for a loan on the same house or car will only count as one. Soft inquiries are when you check your score or when lenders order your report to make a pre-approved credit card offer in the mail. Unlike hard inquiries, soft inquiries have no effect on credit scores. FICO keeps a list of everyone who has looked at your score for 2 years. Hard inquiries only hurt your score for 1 year. Next, your debt utilization accounts for 30% of your score. Utilization is a ratio of debt used to credit available. The more a loan is paid off, the more it helps your score. The less you owe in credit card debt, the better. Having a higher limit leads to a lower utilization ratio, even if you spend the same amount. So credit limit increases will help your score. Have a card that's paid off and unused? It helps your score, but it may be closed due to inactivity. Is it bad to use credit cards? No, because utilization only applies to carrying a balance for multiple months. If you pay in full, you're in the clear. What if you don't pay the full balance every month? Well, you should, but if not, note that there are no specific thresholds to aim for. Just keep it as low as possible. Payment history is the last 35% of your score. It is also the most simple. Did you pay your credit bills on time? If yes, then you'll have a perfect payment history. It's important to note that paying the minimum is all you need to do. Paying the full balance is not required for a perfect payment history. However, if you don't pay the full balance, then your total debt utilization will stay high, and that will hurt your score. Late or missed payments will hurt your score depending on how late they were, how much you owed, how recently they happened, and how often they happen. At this point, we've covered everything in your credit score: payment history, credit utilization, length of credit history, recent history, and credit diversity. These are all pieces of the credit score puzzle. Thank you so much for watching my video explaining credit scores. If you'd like to learn more, I'll soon have a video up addressing frequently asked questions and common misperceptions on credit scores. I'll also have a video on how to effectively use credit cards so they're entirely beneficial. If you'd like to see the video in text form, I have the script up on my website. Finally, all sources are available in the description below. Thanks for watching.